Hey ladies and gentlemen, welcome back to the channel. As always, it is Nick here, back with your daily crypto news and analysis. And today, we're going to be talking about Ripple and XRP, so let's just dive in and let's start off with this tweet here from Ripple themselves. So, this got posted yesterday, and we do see open banking has the potential to transform payment systems across North America, but 55% of US adults have never even heard of it. Read how crypto and open banking intersect and what trends to expect in the future. Now, when we actually go over to this, we also have this article mentioned within Ripple's breakdown, and this is the future is open. The U.S. turns to open banking. This got posted back a year ago in October 15th, or October of 2021, October 15th, and we do see open banking is a concept that describes banks and other financial institutions, such as credit unions, providing rights to customers over their financial data, including the ability to access, share, or port data to third parties for various services. The inherent tensions found in open banking between privacy, competition, and data portability requirements mirror similar concerns across the spectrum of big data. Current challenges to a widespread and healthy open banking ecosystem in the U.S. include a lack of harmonized rules and principles for maintaining strong privacy protections involving financial data, and an absence of standardized technical architecture. The Consumer Financial Protection Bureau, CFPB, will take the lead on facilitating open banking in the U.S. and crafting rules regarding data protection and security. The CFPB should consider lessons learned from international approaches. Open banking proponents and policy makers should be mindful of the unique sensitivity of financial information and the complex data protection risk raised by increased sharing of banking data, even when sharing is directed by consumers. Now, in my opinion, when we look at what open banking really means, this is a bridge between all of the major banks. And I think that when we look at open banking as well, I think that ISO 20022 is going to be a big shift within that. But we do see this is an article that got posted back in February of this year. Open banking on the rise in North America. Open banking is poised to transform business operations and payments transactions across North America as fintechs and banks explore alternatives to debit and credit card transactions and lean into account-to-account payment networking. Education and additional regulatory guidance around open banking will help usher in this new paradigm. And we do see down here regions where open banking has already made its mark has seen a rise in competition and downward pressure on margins. This has driven financial institutions to either find new revenue streams or new cost-saving measures. Now, why is this big? Well, just recently we talked about the savings utilizing XRP, especially from the financial institutional grade area. It is a 33% cut on those financial, it's FX rates. So FX rates is the big area to focus on with financial institutions. Having that area focused on from Ripple with on-demand liquidity brings a 33% deduction in fee base, but utilizing XRP as on-demand liquidity source will be a 60+% savings fee for them. So these cost-saving measurements is huge. And we do see the emerging open banking landscape with its burgeoning crypto innovation has the opportunity to provide solutions to both. While the impacts it may have on banks and payment service providers must be considered, there is ample opportunity for consumers and benefits for the economies to which they contribute. And here's a primer on open banking. They do mention it down here. It takes place when banks and financial institutions give customers and customer-approved third-party digital access to financial data. These third parties are often able to initiate payments as well as download and easily share information on account balances, payments, transactions, investments, and more. And open banking is already gaining traction in, big surprise, the UK and Brazil. Two areas that Ripple has made a huge stepping stone into. We also do see there are a number of benefits to open banking, such as broadened revenue streams through a new API-enabled product, improved customer personalization and satisfaction via increased touch points, and strengthened relevance for financial institutions by diversifying their client offerings. So, again, as we look at things happening, this is very, very interesting, and we actually do see down here progress doesn't occur in a vacuum. The trend towards open banking is buttressed by at least two forces: U.S. consumer demand and the rise of regulatory clarity. In terms of consumer demand, the Open Banking Report notes that with its 14,000 plus financial institutions, think about that, 14,000 financial institutions. This is larger than SWIFT. and a growing number of fintech startups, the United States is likely the next frontier of the open banking evolution, as its consumers have a growing interest in accessing innovative payment experiences while still retaining control over their data. So this is huge, and a big barrier to success is obviously regulatory uncertainty. I think that when we look at regulations, this will bring in a possible 14,000 plus financial institution domino effect to Ripple with XRP because of the cost savings. The cost savings are too large to ignore. Now, as we look at open banking, as we look at interoperability and things like that, yesterday we did talk about a bridge between two big areas. And here we have yet again another breakdown thanks to XRP Darren at Fame21 More over on Twitter. We do see Bank of Thailand. It's funny because we have RizXRP responding with XRP being at the forefront, a bridge currency to everything. Bridging the gap between traditional and digital finance with blockchain, Ripple's mission from the beginning was to transform the way value is moved across borders, especially in emerging markets. One of Ripple's early use cases of payments is cross-border remittances. Ripple's blockchain cross-border payment solution has massively improved the lives of foreign workers whose major financial priority is to send money back home for their family. Moreover, Ripple's on-demand liquidity service has enabled instant move of value through blockchain, releasing idle capital across markets and also improving cross-border treasury flow. Playing the middleman role between financial institutions and the innovative frontline crypto-friendly institutions, Ripple believes that cryptocurrency and fiat money will coexist for a long time. I think that this should also paint a picture on just how large of an opportunity XRP plays here. Their long-term mission and their goal is to make XRP the bridge currency between almost all of the money, if anything, all of the money. This is a huge opportunity. Now, also, we did see down here from Nevermind, XRP Nevermind, he did post this under Darren's post, and it does say, Bank of Thailand Swift is popular but still has high fees and takes a long time. This is the Bank of Thailand speaking. All of these major banks want to utilize something where it is a bridge currency because it's going to transform the way value is not only moved but also settled. Those are two big areas. I said it time and time again in the past, Swift will inevitably utilize Ripple tech. I think that's inevitable. I think that what Swift can create is nowhere near what Ripple has already solved with on-demand liquidity as a service, but also just in general, the efficiencies that we have from Ripple's side is far too great to ignore from a financial institutional standpoint as well as from just a financial standpoint. This is a huge area that we all should be focused on, is the bridge currency aspect around XRP. Now also, Basel 3. So Welshie Outdoors posted this over on Twitter, and I found it very interesting. So we do see here, January 1st, 2023. I don't think that this is going to be a big date to follow, just so to let you guys know. But I think that we should pay attention to Basel 3, especially as it does get implemented. But we do see full, timely, and consistent implementation of Basel 3 is fundamental to a sound and properly functioning banking system that is able to support economic recovery and growth on a sustainable basis. Consistent implementation of Basel standards will also foster a new level playing field for internationally active banks. Now, down here, they do say that these reforms will take effect from January 1st, 2023, and will be phased in over 5 years. Now, the interesting thing about Basel 3 that I think is very interesting is when we go over here from June 30th, 2022, yes, this year, Basel Committee publishes second consultation document on the prudential treatment of banks' crypto asset exposures. Now, let's zoom in here real quick. Let's look at these three base points. The Basel Committee's second public consultation on the prudential treatment of bank crypto asset exposures builds on the proposals in the first consultation issued in June of 2021. Unbacked crypto assets and stablecoins with ineffective stabilization mechanisms continue to be a subject to the conservative prudential treatment, with a new limit proposed on gross exposures, which I completely agree with. Now, we do see the committee invites submissions on the proposals by September 30th and aims to finalize the standard around the year end, which is going to be happening very, very soon. Now, We have this full-on document over here, which kind of breaks down what this actually means, more so centered around like the second consultation, which is this. This got posted back in June 30th, like I said, and this is issued for comment by September 30th, 2022. And when we look at a few things in here, I only want to mention a few things that I have picked up on in this document that I think is very, very not only interesting, but it could be fundamental for our financial system. So we do see over the past years, the crypto asset market has rapidly grown. Since the publication of the first consultative document, the crypto asset market has expanded further through, although during the past 6 months, the aggregate value of the market has contracted significantly. While the crypto asset market remains small relative to the size of the global financial system, and banks' exposures to crypto assets are currently limited, its absolute size is meaningful, and there continue to be rapid developments. I want you guys to make note of the crypto assets are currently limited in terms of the bank's exposures. You know what's funny about this is that once regulations are ushered in, this is no longer going to be limited. It's going to be unlimited amount of exposure to crypto assets, and this is going to change everything. Now, we do see the committee believes that the growth of crypto assets and related services has the potential to raise financial stability concerns and increase risk faced by banks. Certain crypto assets have exhibited a high degree of volatility and could present risk for banks as exposures increase, including liquidity risk, credit risk, market risk, operational risk, including fraud and cyber risk, money laundering / terrorist financing risk, and legal and reputation risk. What solves all of this? Proper regulations. It's very simple. Now, another thing that I do also want to mention around this article is it was around stablecoins. So as we look at a few things, they mentioned, pegging and all that kind of stuff too. Of course, the U.S. dollar, the backed reserves, all that kind of stuff that we really kind of focused on with, SBF and FTX. But here is infrastructure risk add-on. So they are mentioning DLT. So the committee remains concerned that the DLT infrastructure on which crypto assets are based is still new and evolving and may pose various unforeseen risk. The reason why they are focused on this is the fact that they want to assess their benefits. So the committee will continue to monitor the evolution of DLT technologies, assessing their risk and benefits. Based on the monitoring work, the committee will, if appropriate, make adjustments to the calibration of the add-on. So they are preparing to not only utilize DLT in the financial system, but they do see a great benefit within it. They have focused on liquidity in this as well, tokenized claims on a bank, stablecoins, and even other crypto assets. And at the bottom here, one thing that I did want to mention real quick, I think it might have been on slide 13. So this is where they do talk about stablecoins. So they mentioned stablecoins quite a bit because they want to utilize stablecoins the same way they kind of want to utilize XRP, if you will, or how we look at them utilizing XRP. They want to utilize stablecoins very similar to how we are looking at like CBDCs, them being at the bridge front. But the problem with that is that stablecoins are not going to work like that. You still need a bridge asset. They've been doing a lot of tests like this. Again, none of it comes close to what on-demand liquidity has solved because, again, you still have a fragmented system. You have two completely different assets that still need that bridge currency to transact and settle those payments. Now, this goes on and on about stablecoins mainly because that's what we have focused on, especially even with Quant. But this piece here was very interesting. So they do mention tokenized traditional assets. Derivatives and SFTs on Group 1A crypto assets will generally be subject to the same rules to determine CVA RWA as a non-tokenized traditional assets, i.e. the rules set out in the market risk standard, MAR50. In other words, if a bank holds a derivative or an SVT on a tokenized asset, having a price close to the traditional asset and being subject to CVA risk as is set out in MAR50, it will be reflected in the CVA risk change or charged in the same way as a derivative or SVT on the non-tokenized traditional assets. Banks must assess the tokenized traditional asset itself against rules set out in MAR50. Qualification for a given treatment cannot be derived from the respective traditional non-tokenized asset, and again, not limited to, but the liquidity characteristics as well. Different liquidity characteristics between traditional non-tokenized assets and the tokenized asset could result in a higher basis risk between the two. Guess what solves this as well? the XRP ledger. Tokenization itself, like all of this, what they are mentioning in here, they're seeing some great opportunity for DLT and crypto, but they are assessing a lot of the risk. The reason why they broke all of this down is because with Basel III, they're going to plan ahead. They're going to study and make sure that they understand the risk involved with all of this, because they want to issue out stable coins, as you guys do see here, and banks are going to be issuing this as well, but they need to understand like all of the outflows. They need to make sure that everything is transparent. They need to understand everything around stable coins. They want to utilize this technology. They just don't know how to fully do it yet, as they are doing a lot of planning around this. I do think that Basel III will most likely push towards that. I think that we will see a lot more exposure around crypto. Again, I think that as we do push into like the open banking area, and as we do see a lot of these bridges being created, as we do see Swift being kind of, I mean, like Swift itself is very inefficient. We've talked about this many times on this channel. I think that we will see something much larger rise. If not, we will see Swift utilize Ripple technology, which I think would be very beneficial. But one thing that we know for sure is that a bridge between traditional and digital finance itself is going to be a key area to focus on. We talk about this a lot with Quant. We are seeing the big shift happening. We are seeing major financial institutions and banks wanting to utilize this technology. The BIS is doing a ton of studies on it. They understand the risk involved. This was posted on June of 2022. I would argue that within the next roughly 2-3 years or so, everything around this is going to change rapidly, and the BIS is probably going to be extremely bullish on DLT. If not, maybe they will be utilizing it at that time. Who knows? But you can see things being planned. You can see things being tested. They are trying to utilize this technology because they see the value behind it. And with that being said, I hope that you guys enjoyed this video. If you guys did, definitely leave a like, subscribe to notifications, notifications more free content. You guys are more than welcome to follow me on Twitter and join the free Discord down in the description below. As always, up to you all. Have a beautiful day, beautiful night. If you guys are on this before, this has been Nick. Peace out, guys.